Introduction to Capital Investment Appraisal. Capital investment appraisal, also known as capital budgeting, is the process of evaluating and selecting long-term investment projects to determine their financial viability and alignment with strategic goals. It involves assessing potential expenditures on fixed assets, such as machinery, equipment, or new business ventures, to ensure they generate sufficient returns for the business. Importance of capital investment appraisal. Resource allocation. Ensures that limited financial resources are invested in the most profitable and strategically beneficial projects. Risk assessment. Evaluate the risks associated with capital investments and provide a basis for informed decision-making. Long-term planning. Supports strategic planning by analyzing the financial implications of long-term investments. Maximizing shareholder value. Prioritizes investments that yield higher returns, ultimately enhancing shareholder wealth. Capital investment appraisal techniques. Net present value, NPV. Definition: measures the difference between the present value of cash inflows and outflows over the project's life. Purpose: determines whether the project will add value to the company. Decision rule: accept the project if NPV are 0, reject if NPV are 0. Internal rate of return, IRR. Definition: the discount rate at which the project's NPV equals 0. Purpose: evaluates the profitability of the investment as a percentage return. Decision rule: accept the project if IRR are cost of capital, reject if IRR's cost of capital. Payback period. Definition: the time it takes for the initial investment to be recovered through cash inflows. Purpose: measures the speed of investment recovery. Decision rule: choose the project with the shortest payback period. Discounted payback period. Definition: similar to the payback period but considers the time value of money. Purpose: provides a more accurate measure of investment recovery time. Decision rule: prefer projects with shorter discounted payback periods. Profitability index, PI. Definition: the ratio of the present value of cash inflows to the initial investment. Purpose: shows the relative profitability of a project. Decision rule: accept the project if PI are 1, reject if PI are 1. Accounting rate of return, ARR. Definition: measures the expected annual accounting profit as a percentage of the initial investment. Purpose: focuses on profitability in accounting terms. Decision rule: accept projects with ARR exceeding the required rate of return. Factors to consider in capital investment appraisal. Cash flow projections. Accurate forecasting of inflows and outflows is essential for reliable appraisal. Risk and uncertainty. Consider factors such as market volatility, economic conditions, and project-specific risks. Cost of capital. Use the company's weighted average cost of capital, WACC, to discount future cash flows. Strategic alignment. Ensure the investment aligns with the company's long-term objectives and competitive positioning. Regulatory and environmental considerations. Evaluate compliance with laws, regulations, and environmental sustainability goals. Limitations of capital investment appraisal. Accuracy of assumptions. Outcomes depend heavily on the accuracy of cash flow and discount rate assumptions. Time value of money complexity. Not all managers are proficient in understanding discounted cash flow methods. Non-financial factors. Qualitative aspects, such as employee morale or brand reputation, are not always captured in financial models. Risk assessment limitations. Models may not adequately account for unforeseen risks and uncertainties. Real-world application. Capital investment appraisal is used across various industries to evaluate decisions such as expanding manufacturing facilities, launching new product lines, acquiring new technology or equipment, entering new markets or geographic regions. Conclusion. Capital investment appraisal is vital for ensuring that resources are invested wisely to achieve financial and strategic objectives. By leveraging quantitative techniques like NPV, IRR, and payback period alongside qualitative considerations, businesses can make informed decisions that drive growth and long-term success.